doing well. Well, how did checking accounts begin? In the early 1500s, in Holland, Amsterdam was a major trading and shipping city. Merchants who acquired large sums of money needed a place to locate their cash. Thus they began to pay the cashiers, who held the money they deposit. This induced more people to become cashiers due to the great demand of deposits. Competition caused cashiers to offer additional services, such as a note was kept for the proof of the payment by a depositor, that would allow them to withdraw money from the depositor's account. This concept has spread to other countries, including England and its colonies in North America. In 1681, landlords in Boston mortgaged their land to the cashiers who provided an account, so that the landlords could write notes or checks. In 18th century in England, banks began to print checks on behalf of their customers. The first printed checks are traced to British banker Lawrence Childs in 1762. These checks featured serial numbers, to keep track of them, and the word check started being used. The 18th century was the period, which new services began to be standardized and widespread. This was the period, when enough banks began to standardize their checks, that lead to the difficulty of clearing checks and the development of clearing houses. What are the pros and cons of using checking accounts? It is safe and convenient to have a checking account. Owning a checking account eliminates the need to carry cash. Nowadays, checks are accepted at many places, and are used to replace cash. A check is written instead of withdrawing money from bank when cash is needed. Besides, in the United States, checking accounts are FDIC Federal Deposit Insurance Corporation insured, hence they are a safe place to store money. The FDIC insures each depositor replacement of their deposits, up to $250,000, in the event of bank failure. Moreover, majority of institutions do not offer interest-paid checking accounts except for certain institutions, so most customers do not need to pay interest for the money deposited. One disadvantage of checking accounts is that many checking accounts impose a minimum balance requirement. For example, for CIMB current account, RM10 is charged, if average credit balance is less than RM1000. If the balance in a person's account falls below the requirement, fees are charged. Overdraft fees also charged if a checking account gets overdrawn. As I mentioned, that checking accounts in us is insured by FDIC. Here is a brief history of FDIC. The Federal Deposit Insurance Corporation (FDIC) is a United States government corporation, which operates as an independent agency established by the Banking Act of 1933. The FDIC was created in 1933, to respond to the thousands of bank failures, which took place in the 1920s and early 1930s. The purpose of creating FDIC is to maintain stability and public confidence in the nation's financial system by ensuring deposits, examining and supervising certain financial institutions for safety, soundness and protection, and managing receiverships filled banks. Since the commencement of FDIC insurance on January 1, 1934, there is no depositor has lost any insured funds as a result of a failure. Here is an interesting invention history for the ATM and credit cards. Invention of ATM. The automated teller machine ATM is a complicated piece of technology, that it does not have a single inventor. But many experts believe that the first automated banking machine was created by an American inventor and businessman, Luther Samigian. It was called the Bankograph. In 1960, Samigian managed to persuade a New York City bank to take a few of his automatic deposit machine. To gain trust from customers, that they would see their money again, there was a microfilm camera inside the Bankograph which took a snapshot of every deposit. Customers received a copy of the photo as their receipt. However, the Bankograph did not become popular. The only people using the machines were prostitutes and gamblers, who didn't want to deal with tellers face to face. Samigian explained. Besides, there were not enough of them to make the machine a worthwhile investment. In 1967, Barclays, a London bank, accepted the idea of a Scottish inventor named John Shepherd Barron, and installed his first ATM in a branch on Enfield Street. Unlike modern ATMs, they did not use plastic cards but paper voucher printed with radioactive ink, which the machine could read them. The first automated banking machine in the U.S. was devised by a Dallas engineer and former professional baseball player named Donald Wetzel. Wetzel's machine used plastic cards, which could store account information in magnetic strips. In September 1969, Wetzel's first machines were installed in a chemical bank branch on Long Island. Invention of credit card. Credit card is a payment card issued by financial institution, which allows cardholders to borrow pre-approved funds at the point of sale for purchases. The concept of credit has developed in the late 1800s where consumers and merchants exchanged goods using credit coins and charge plates as currency. In the early 1900s, oil companies and department stores issued their own proprietary cards, which were only accepted at the business that issued the cards and in limited locations. According to MasterCard, the first bank card, named Charge It, was introduced by John Biggins in 1946, a banker of the Flatbush National Bank in Brooklyn. The bill was forwarded to the bank, when the customer used it for purchases. The bank repaid the merchant and received payment from the customer. The purchases could only be made locally, and cardholders had to create an account at the bank. The concept of customers using the same card to pay different merchants was expanded in 1950 by Ralph Schneider and Frank McNamara, founders of Diners Club. According to a representative from Diners Club, the idea came out when Frank McNamara realized that he had forgotten his wallet when he was having a business dinner in New York's Major S Cab and Grill. He and Frank McNamara returned to Major S Cab and Grill in February of 1950, and paid the bill with a small cardboard card. The Diners Club then produced the first charge card, and required the bill to be paid with each statement. This concept was followed by American Express, which issued their first credit card, and created a worldwide credit card network. Credit cards were first introduced to traveling salesmen for use on the road. By the early 1960s, more companies started to offer credit cards, advertising them as a time-saving device rather than a form of credit. American Express and MasterCard became huge successes overnight. Internet is a place where information is shared and communication facilities are provided. With the help of Internet and technological advancement, e-checks are invented. E-check is a form of payment using Internet under electronic funds transfer (EFT), which performs the same function as a conventional paper check. It is the first and only electronic payment mechanism chosen by United States Treasury to make high-value payments through the Internet. It is secure, as it provides security features such as authentication, public key cryptography, digital signatures, certificate authorities, duplicate detection and encryption. It is a new and popular method of payment among the United States nowadays. Finally, the electronic money, the latest and most advanced evolution of money,